So hello everyone, welcome back to the Small Business Podcast after we had a short hiatus, government mandated break, as some people would say. We're back just to talk about types of taxes for small businesses. So what are the main 4 types of taxes that small businesses would see on a day-to-day or yearly basis?
Yeah, great question. So, I mean, the common ones that you'll see are income tax, being tax on profits, GST, which is a 10% or generally 10% on goods and services, most of them. PAYG Instalments, which is just a prepayment of your income tax. And then PAYG Withholding, which is taxes on employee wages. So those are the big 4. There's a few others as well that we'll touch on, but the thing that you see most is people that are new to business, and even established businesses, which is where you'd be surprised. They get them all mixed up. So, I think if you can get an understanding of what these are, what the timing of them is, it'll just make things a lot easier for you, because otherwise you're just going to have a headache, constantly getting bills, and you'll lose your mind. So those are the big 4. I'll start us off with GST, and then we can go through the rest. But, GST, as I mentioned, 10% on most goods and services sold in Australia. There are GST-free items, such as, medical items, fresh food, a whole bunch of other things. So they don't attach GST to them, which means when you sell them or buy them, there's no GST on them. A common thing that people don't necessarily understand is it's not an extra tax that you necessarily pay. So like, let's say you go to the shop and you buy something for $110. The GST is in that $110. You're not paying an additional tax after that. So it's taxed at that point that you buy or sell. Remitting it to the ATO is another thing. And that's where, if you're on a cash or an accruals basis, will depend when you remit that to the ATO. So if you're on a cash basis, you remit your GST when you pay the physical cash. Accrual is on invoice. So if you send an invoice to a supplier, you'll pay the GST at that date, not when you actually pay them. So that's something that's important to keep in mind.
Yeah, so that's right with the GST. There's 10% usually on goods you sell or 10% on goods you buy. Same with services. And like you said, there's some GST-free items. Healthcare is also a big one. But, if you're a supplier for fruit and vegetables, when you purchase the fruit and vegetables, there's no GST included. And when you sell those vegetables, there's also no GST included. But how it works with the ATO, it's usually reported on a BAS or an activity statement. These can be done monthly, quarterly, or sometimes even yearly if your turnover is low. And how it is let's say you've made $100,000 in sales, there's a 10% GST on that, so $10,000, and you've had $50,000 worth of expenses, so there'd be $5,000 worth of GST. You technically owe the ATO the difference of that, so $5,000 in that example needs to be owed to the ATO. So a good thing to keep in mind is, yes, you've received $110,000, but that $10,000, you need to kind of put that aside as well. With when you spend $55,000, the difference of that will be paid to the ATO. And like Andy said, with the cash or accruals basis, so when you're in a company or a trust, you can choose to be on a cash or accrual basis. And how that works is, if, for example, you send out an invoice to a client today for $100,000, but the client doesn't pay you for another month, even though you've already invoiced it, if you're on accruals basis, you'll still have to technically pay that GST. If you're on cash, you don't have to pay it until the cash actually arrives. And the same the other way around. If you have a bill from a supplier, if you have received the bill now, but your account is that you pay 30 days at the end of next month, you don't actually have to pay the bill till next month. But if you're on accruals, you get the GST discount, I guess, for this activity statement. But if you're on cash, it's when you actually pay it. So good thing to keep in mind, and something to think about when you're looking at cash flow.
Yeah, and there's very complex scenarios when it comes to GST. I think some people think that GST is pretty easy, 10%, that's it.
Yeah.
It's quite complicated in many areas, so it's always good to get advice on it. But yeah, a lot of it is straightforward, but there is a lot that's super complex. So just keep that in mind. So income tax.
Yeah.
What is income tax, and how do we account for that?
Yeah. So where GST is counted on income and expenses, income tax is calculated on the profit for the business. So income after all expenses, whatever your profit is what the income tax is calculated on. So usually for companies at a certain turnover, pretty sure it's under 50 million in turnover, you pay a 25% tax for income tax. If your company has 50 million or more in turnover or revenue or sales, then the tax will be at 30%. So income tax is a bit different. That's also calculated on a yearly basis, so on a tax return, whereas GST can be calculated on a monthly, quarterly or yearly basis. Income tax is solely yearly basis, where it's calculated on the tax return on your net profit, and that's usually how it's calculated. There's different structures, so I think we've spoken about it in a different podcast, but we'll touch on it again here.
Yeah.
A company will be paying a 25% income tax.
Yep. If it's a base rate.
If it's a base rate. A trust won't be paying income tax because that income gets distributed. Then the income tax gets paid on those beneficiaries or the individuals' marginal rates. So depending on what tax rate they're in is the tax that they'll pay. And that's the same with partnerships and also sole traders, as we discussed on one of the early episodes, if you wanted to have a listen and touch back on that.
And that's where tax planning becomes important, right? Because as you can see from what you just said, individuals get taxed on their marginal rate, companies at 25% or 30%, depending on the situation, and trusts and partnerships pay them down to whoever, so the partners or the beneficiaries. So that's where tax planning can help. If the beneficiaries are bucket companies or another, trust or individuals, there's a lot of planning opportunities there to try and optimize that tax position.
Yeah.
Yeah.
And also the income tax is calculated on accruals. So sometimes we get the question of, what if I just pay a bunch of stuff now? Will it save my income tax? Well, it can, but there's also different ways that it's calculated. So again, with companies for income tax, it's based on accruals. So same with invoices. If you send an invoice on the 20th of June, but don't get paid till after the end of the financial year, it's still calculated as your income. So it's something to keep in mind that, yes, you might not have received the cash yet, but you might still have to pay income tax onto it.
Yeah, that's right. So just to touch on that before we do move on to the next bit, you can also declare on a cash basis and just pay the tax when the cash is received and paid. However, most of our clients are on an accruals basis, and it is the most common approach that we see. So,
especially for companies, sole traders do declare on cash basis, but usually for companies and trusts, it is usually on accruals. But
that's right.
Again, something to make sure you get the right advice on, if that's right for you. It's quite common, which we find with, like you said, most of our clients, but something to be aware of.
Yeah, exactly right. So the other type of tax that we will look at is PAYG Instalments, which isn't necessarily an additional tax. It's just a prepayment of your income tax. Where most people get caught out with this is in they do their first year of trading, they don't make any PAYG Instalments, so no prepayments towards their tax. They lodge their first year's tax return, hopefully within the first quarter or two. They have a tax bill. So they've got that to pay, which is the tax on the profits for the previous year. The ATO will then enter them into the PAYG instalment system. So then they'll want to get the next year's tax prepaid. So they're essentially got 2 years of tax that they're paying in the 1 year. So this is where a lot of people get caught out and things can go really bad. So you really want to get on the front foot with your PAYG instalments. If you can, enter the system as early as possible from that point of profitability. But if you don't, that's fine. We can help you manage that. You've usually got over 12 months to pay that next year's tax bill, if depending on the timing of your lodgements and whatnot. But if we can enter you into the PAYG instalment system, at least pay a little bit and just get on the front foot. It's going to help you a lot. So
yeah. And just a touch note with the PAYG Instalments. The PAYG stands for Pay As You Go. So it's the ATO's acronym for paying your tax as you go throughout the year.
Yep.
And like you said, it's prepayment for tax. These can also be adjusted, so it's not just a set amount. If you've done your tax plan with your accountant and you can see that you're expected to make less than what you've actually paid throughout the year, you can adjust those installments so you don't overpay. And while overpaying is not the worst, it does mean you have less cash in your pocket. So it's good to not be overpaying your pay as you go throughout the year, just because it lets you have more cash to be able to use elsewhere. And again, you also don't want to underpay, because underpaying throughout the year can just catch you out when you have to do your tax return. You have another tax bill. It's quite good to be, steady, try and pay it off throughout the year. And like I said, you can adjust it, but there are some issues sometimes with the ATO. If you're expected to have a big tax bill, but you've adjusted all your installments to zero throughout the year, the ATO may come looking and say, you knew you were going to have a tax bill, you've adjusted all your installments to nil, it can give you penalties. Obviously it's rare, but it can happen. So it's just another tax to be aware of, or not exactly a tax, but something to be aware of. And these installments usually paid throughout your activity statements on a quarterly basis. So even if you do pay GST monthly, the pay-as-you-go installments will still be on a quarterly basis. So each quarter, March, September, June, and so on.
Yeah, that's right. And that's why it's so important to do tax planning throughout the year rather than just at one point in time, because then you can get these PAYG installments to be accurate, minimise the effect it has on cash flow, and just put you in a good situation come into financial year. So, yeah. Cool. PAYG Withheld. So very similar, pay as you go withheld. So similar to PAYG Instalments, but it's just for the employees basically. So it's paying their tax throughout the year. Basically, it's automatically done through the software that's, so Xero, for example, run the pay run. It'll calculate the amount to withhold. You just pay the net amount to the employee, pay their super, and then the tax gets paid to the ATO. It is the employer's obligation to do that, not the employees. So it's essentially, just another cash outflow for the business that needs to be paid each pay run. So.
And that's also done on a monthly or quarterly basis. So usually done alongside your GST, or sometimes you might have your GST on a quarterly basis and your pay-as-you-go withheld on a monthly basis. So if you pay a certain amount of wages in a month, whatever tax is withheld from all those employees can be paid on that activity statement, that monthly activity statement or quarterly activity statement. And like Andy said, it's the tax for the employees' wages. So when you, figure out what wage you want to pay your employees, it's also considering the tax withheld and also super. You're not actually you've decided on paying them 80 grand a year, they're not actually going to be receiving 80 grand because tax will be withheld. Part of that goes to the ATO that the company or trust or the employer pays, and then the rest goes to the employee, and also the super on top of that.
Yeah, that's pretty much it for that one. So what are some common mistakes or tips that you'd recommend people get on top of all this? I
think it's a good thing to understand the difference. We get a lot of questions of people not understanding the difference between GST and income tax, or GST and pay-as-you-go installments on their activity statements. So usually when you receive an activity statement, it's split out line by line what each amount is for. So you have GST, pay-as-you-go installments, pay-as-you-go withheld, and there's also some other taxes as well that we'll touch on. But it's important to understand what they are, just because you understand the differences. I mean, some people are saying, I'm paying so much in tax throughout the year, why do I have another tax bill once you do my tax return? It's just because the tax throughout the year is different compared to the income tax that you receive your tax return. So it's good to understand that, and also making sure that you account for that as well in your cash flow. And if you have had a big tax bill the previous year, you're most likely going to have some larger installments throughout the year. So it's important to keep that in mind and make sure you stay on top of it early. Get those activity statements sorted early, and don't leave it to the last day, or the due date, because that's when the installments might have changed from the previous quarter because your tax return's been lodged. You had a big tax bill, and now the ATO says, you're probably going to have the same thing this year. We're going to bump up your installments. And if you had, for example, a $100,000 tax bill, your installments each quarter will be $25,000 because they're expecting the same.
Yeah.
They want it to be split between those 4 quarters just because the ATO wants the money earlier. So that's how that works, and that's important to understand.
Yeah, and being on time, like you mentioned, is important, because if you do want to vary those installments, you've got a certain period where you can vary it, and then it's just locked in. So that's important.
Yeah.
The other one we see is people opening up separate bank accounts to put the different taxes in, so different buckets of taxes, for example. So that is a good tip. If you need help with managing that cash flow, set up a different bank account for each of the taxes, and just using technology. So, using your software, checking your P&L, checking your balance sheet, understanding the figures in those, and making sure that things are, running as they should.
Yeah. And if you don't understand them, make sure you speak to your accountant or speak to your advisor to be able to understand them. I think it's important to have that understanding and not just hand it off to someone else to sort out.
Yeah.
Because if you don't understand that, it's going to affect you further on with running the business. So it's important to understand that stuff.
Yep. So the other taxes that people should be aware of, but we won't go into detail, are fringe benefits tax, which is a tax on basically providing benefits to employees, associates, etc. Capital gains tax, which is a tax on disposal of capital items. Payroll tax, which is a tax on paying employees. There's thresholds for that as well.
Usually over $1 million, I'm pretty sure, in payroll. So if you have a lot of employees, you're paying over $1 million in payroll for that year, you actually have to pay more tax for that, which is quite frustrating, but you might get caught out with it as well.
Yeah, exactly right. There's WET, which is wine equalisation tax, which is quite complex. So if you're interested in that, let us know. Luxury car tax and fuel tax credits. So there are lots of different taxes that they need to be aware. Not all are applicable. So, we've covered the main ones that people will come across, and then these are just additional ones that, are more specific to the business that people are running. So if you're interested in any of those, obviously ask your accountant or reach out and we can have a chat about it.
Yeah, absolutely. And just to recap on all the points, with the GST, which is the goods and services tax, 10% on most goods and services sold or purchased. Then there's income tax, which is tax on your net profit for the full financial year. PAYG Instalments, which is prepayments of your tax throughout the year, of your income tax, and then PAYG Withheld, which is tax withheld from employees, which is paid to the ATO. So those are the 4 main taxes that you'll most likely see starting a business, especially if you're on the lower end. And then as you grow, there might be other taxes you have to pay, like FBT, payroll tax. And if you're in freight and delivery, if you have trucks over 4 tons, you might also see fuel tax credits, but we can go into that in a different day. But yeah, those are the 4 main taxes that we see.
Yeah, so many things to keep in mind, isn't there?
Yeah. That's why you need a good accountant in your corner to help you out.
That's right. And look, paying tax isn't bad, right? If you're paying tax, you're usually doing all right. If you're not paying tax, that's when you need to probably reevaluate, okay, is the business doing what it should be doing? A lot of people focus on minimizing the tax when if you focused on growing the business and optimizing that, the tax will take care of itself. So just another little point. But All right, cool. Thanks for listening, hey?
Yeah. See you next time.